Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening with the economy in China. China has just released its Q1 figures for 2024, and at face value, these figures look fantastic because China has reported GDP growth of 5.3%, which actually exceeds all of the expectations. Everybody was estimating that they were going to do somewhere between 4.5 and 5%. So 5.3% looks like China have hit it out of the park. However, you always have to look at the detail as to how these figures have been arrived at, and also what's really important when you're doing economic analysis is to look at the trend. And what we're going to look at today is what's happened in March, which is obviously the most recent month, and tells us what's going on in terms of that trend and what's likely to happen over the course of the next 3 to 6 months. And I can tell you that there are some very worrying signs for China in terms of how it arrived at that 5.3% growth figure for the first quarter and what's happening right now with some of the very basic fundamentals. So we're going to have a look at what's gone on with exports, and I can tell you that exports in March are significantly down against both expectations and also in real terms. We'll have a look at what's gone on with imports because China is a big importer. It imports lots of raw materials, which it then manufactures and turns into finished products, which it then exports. So imports give us a really good indication as to what's likely to happen further down the road. And once again, I can tell you that imports were down in March. So again, a very worrying trend. We'll then talk about what's happened with industrial production because this is the area of the economy that the Chinese authorities have the most influence on. If they want to stimulate the economy and increase GDP, that's how they do it. So we'll have a look at what's gone on in the first quarter with industrial production and what happened specifically in March. We'll then have a look at what's going on with inflation because China has been struggling with deflation over the last 6 months. And once again, this is now proving to be a problem. We'll talk about what's happening with producer prices because they give us an indication as to what's likely to happen with inflation further down the road, where China is with regards to consumer spending because it needs its 1.4 billion people to be going out and spending money to try to get the economy back up and running again. We'll have a look at what's happening with new home prices because they've fallen at the fastest rate for 9 years in March. And then finally today, I'll wrap up with my summary as to what I think is happening right now in the economy in China and what's likely to happen over the course of the next 3 to 6 months. But before we get started on all of that, I'd like to say thank you so much to everybody that's supporting the channel. If you've bought me a coffee or sent me a YouTube super thanks, thank you so much for the time and effort that you've taken to do that. I really, really appreciate every single one of those. I don't get time to respond to everyone. If I could, I would, but thank you if you've done that. And if you've signed up as a long-term supporter of the channel, either through Patreon or YouTube membership or Buy Me a Coffee membership, thank you for that long-term support. It tells me that I'm doing something right, that you're enjoying the videos, and it gives me more motivation to think up more topics and post more videos like this. So thank you so much. As I mentioned at the start of today's video, China achieved 5.3% GDP growth in the first quarter of 2024. And headlines such as this one would lead you to think that China is doing fantastically well and it's going to be on track to hit its 5% growth target for the rest of this year. However, you need to look into the details as to what's driving those figures. And one of the main drivers has been the government's support of industrial production. So this is basically government-sponsored programs to build lots of different things, which is then funding lots of businesses. This chart shows the year-on-year movement in industrial production in China. And the scale on the right-hand side of this chart is shown as a percentage and goes from 0 at the bottom to 7.5% at the top. And what this chart shows is that in 9 out of the last 12 months, the year-on-year movement in industrial production was at or below 4.5%. However, in 4 months, it was significantly above 4.5%. And this represents periods when the Chinese authorities are looking to stimulate the economy, when they input a huge amount of capital into business in order to drive up the GDP figures. And the 3 months that I want to focus in on in terms of this analysis are the 3 on the right-hand side of this chart, which are actually November, December and February. China doesn't report any figures for January, and what we can see here is that in November, the year-on-year movement in industrial production increased dramatically from 4.6% in October to 6.6%. It then increased further to 6.8% in December and increased again to 7% in February. So what this shows us is that the Chinese authorities was inputting a huge amount of capital in order to drive up the GDP figures for the first quarter of 2024. Now, interestingly, when you look at the figure for March 24, it falls back to 4.5%. Now, what's interesting about this percentage is that that isn't the recorded figure just for the month of March. This is a 12-month rolling figure. So when we're looking at the 4.5% in March, that represents industrial production from April 23 to March 24. So when you take into account the huge stimulus that was driven in the previous 3 quarters, what we're seeing in March is actually a huge fall in industrial production. And when you look at the figures in this way, it shows you why it's so important to look at the trends, to work out what's happening over the next 3 to 6 months, because you need to look at what drove the quarter 1 GDP figure up and whether or not that's being sustained, or if it was just a short-term blip and we're now going to see a hangover. And that's exactly what we're expecting when you look at these figures, because we've had this huge influx of capital to drive up industrial production, but it hasn't been sustained. And therefore, what's likely to happen in the second quarter of 2024 is that GDP will fall back down, unless the Chinese authorities do the same thing again over the next couple of months. As I'm sure you'll be aware, China is the second largest economy in the world, and its economy is based upon manufacturing and export. It produces millions and millions of different products which are exported all around the world. So the level of exports in any particular month is a really important indicator to tell us exactly what's happening in the economy. This chart shows the year-on-year movement in the value of China's exports over the last 12 months. And this shows a really interesting trend. In April 23, China experienced growth of 7.3%. And at that stage, there were high expectations that 2023 would be a very good year from China's point of view. However, as you can see, over the following 6 months, those hopes were dashed as exports fell 7.3% in May, 12.4% in June, 14.3% in July, 8.4% in August, 6.8% in September and 6.6% in October. Things once again started to pick up in November when exports moved back into positive territory and increased by 0.7%. They increased further by 2.3% in December. And in January 24, China achieved 8.2% growth in exports. However, in February, the growth in exports reduced to 5.6%. And in March 24, we've seen a 7.7% fall in exports, which represents a net turnaround of more than 13% against the growth seen in February. And these figures for March represent an absolute disaster from China's point of view, because the economy is dependent upon its exports. And if you take a step back and have a look at what's happened in the first quarter of 2024, China saw growth in its exports in January and February. However, the latest trend in terms of what's happened in March tells us that there's been a dramatic fall in exports. And this is again one of the reasons why you have to look at the details when you're analysing trends. Don't just look at headline figures such as 5.3% growth in GDP in the first quarter of 2024 and assume that everything is going really well. Although China is a net exporter, the volume of its imports is also a really important metric, because it's importing lots of raw materials which it uses in its manufacturing processes before exporting final goods. And so we need to look at what's happening with imports, because it gives us a really good indication as to what's likely to happen over the next 3 to 6 months with the volume of China's exports. This chart shows the year-on-year movement in the value of China's exports over the last 12 months. And what we can see here is a very worrying trend, because in 9 out of the last 12 months, China has seen a year-on-year fall in the value of its imports. And in fact, when you look at the positive months, which were October, December and January, the scale of those positive increases is actually relatively small compared with the scale of the fall in imports that we've seen over the last 12 months. Now, interestingly, if we look at what's happened in the first quarter of 2024, in January, the value of imports increased by 15.4%, which was actually the biggest movement that China had seen since January 2022. And at that stage, everyone was hopeful that China had turned the corner, that things were really starting to pick up, and that 2024 would be a highly successful year in terms of importing lots more raw materials, processing those materials, and then increasing exports. However, those expectations were short-lived, and as you can see, in February, there was an 8.2% drop in the value of imports, which represents a net turnaround of over 23% compared with the situation for January. And in March 24, we've seen a further fall of 1.9% in imports. So what this tells us is that China is currently importing less than it was this time last year. And if it's importing less raw materials, that means that companies in China are ordering less of their raw materials to produce finished goods, and therefore there's likely to be an impact on exports over the next 3 to 6 months because those businesses will be producing less, therefore they'll be selling less and exporting less, which is clearly very worrying from China's perspective. As well as the growth in international trade, China is also dependent on its home markets, consumer spending from its 1.4 billion population. This chart shows the year-on-year movement in retail sales in China, which tells us how much consumers are spending in the stores and online in China. And the scale on the right-hand side of this chart goes from 0 at the bottom to 20% growth at the top. And what this shows is that in March and April 2023, there was a huge increase in retail sales in China. However, that increase started to tail off in May and June, and by July, the retail sales growth was down to 2.5%. Over the next 4 months, retail sales in China started to pick up significantly and hit a high of 10.1% in November. However, over the last 3 months, we've started to see those figures coming back down, with retail sales growth of 7.4% in December, 5.5% in February, and 3.1% in March. And if you take a step back and look at that trend over the last 4 months, you can see that there is a clear downward momentum here. And what that tells us is that consumers in China are being more cautious, they're spending less in relative terms, and they are not driving the growth of the economy. China is targeting GDP growth of 5% for 2024. So when you think about the contribution from retail sales in the home market, China is looking for retail sales growth of around 5%. So 3.1% growth in March is not sufficient to hit that 5% target for 24. And the trend is very worrying because if retail sales continue reducing at the same sort of rate that they have for the last 3 months, then it's likely that we will get closer to 0% rather than 5%. And that's going to put even more pressure on exports because they're going to have to pick up the slack that's being left by retail sales. One of the biggest issues that the Chinese economy has encountered over the last 6 months is the emergence of deflation. Prices have actually been falling in many months in China, and that's as a result of a reduction in demand. So the issue that we just talked about in terms of consumer spending falling. And the problem that you have when you have falling demand and falling prices is that it makes it difficult for businesses to actually make any profit, because most businesses work on the assumption that their prices will rise year on year. So therefore, they can afford to pay more for raw materials, they can afford to pay their staff more. Everything is built on the assumption that you'll get paid more for your finished product. So if your prices are actually falling on the shelves, what that means is that you're being paid less, you're making less profit, and therefore it's putting pressure on you to maybe reduce the number of your staff or cut your costs. And that then becomes a vicious circle. So let's have a look at what's happening with consumer prices in China right now. This chart shows the movement in the official rate of inflation in China over the last 12 months. And the scale on the right-hand side of this chart goes from 0.8% positive at the top to 0.9% negative at the bottom. And if we look at what's been happening over the last 12 months, you can see that China has only achieved a positive growth in prices in 5 months, it's had zero growth in 2 months, and has actually experienced deflation in 5 months. And if we have a look at what's been happening over the last 6 months, in October prices fell by 0.2%, in November they fell by 0.5%, 0.3% in December, and in January 24 prices fell at their fastest rate of 0.8%. Now interestingly, that situation was reversed in February when prices actually increased by 0.7%, which represents a 1.5% net turnaround from the situation in January. However, if you look at the position for March, you can see that that momentum has been entirely lost and prices only increased by 0.1%. And once again here, if we look at the trend between February and March, it's significantly downward, and it indicates that there is a very real possibility that China could experience deflation again in the second quarter of 2024. Now, when we're looking at inflation, one of the key metrics is what's going on with producer prices, or what's also called factory gate prices. So these are the prices that companies are pricing their products as they leave their production lines. So it's basically telling us, are prices going up or are prices going down? And this chart shows the movement in the Chinese producer price index over the last 12 months. And the scale on the right hand side of this chart goes from 1% positive growth at the top to -6 at the bottom. And what this shows is that in every single one of the last 12 months, factory gate prices in China have been falling, and they've actually been falling significantly, above 2% in every single month. And in fact, if you look at the start of this year, in May 23, factory gate prices were down 4.6%, and they hit a peak of negative 5.4% in June. There was a brief recovery over the next 3 months. However, by September, factory gate prices were still falling by 2.5%. And if we look at what's happened over the last 6 months, there was a 2.6% fall in October, a 3% fall in November, 2.7% in December, 2.5% in January. That increased to 2.7% in February. And in March 24, factory gate prices were down by 2.8%. And the reason that this is concerning from China's point of view is that the continued fall in factory gate prices is going to lead to further falls in prices on the shelves, which is going to pull down general inflation further. So it's very likely that China will experience further deflation over the next 3 to 6 months. And that, of course, is a problem because it's going to be difficult to then stimulate consumers, to drive up demand, to drive up GDP. So what we are seeing here is a clear indication that the companies in China are really struggling to increase their prices, and therefore it's going to be difficult for China to move back into a long-term period of inflation. And as we discussed earlier in the video, the problem with that is that a lot of companies in China will now be struggling to make a profit because they've been working on the assumption that prices will go up and therefore they can pay higher costs. If prices are going down, they won't be able to afford those higher costs, and it's therefore highly possible that a lot of companies in China will start making losses. If you've been following the channel, I'm sure you'll be fully aware that the Chinese economy is still dependent on what's happening in the property sector. It accounts for around 25% of total GDP. And of course, over the last few years, China has suffered a complete disaster in terms of what's going on with that property market because lots of the huge developers got themselves into financial difficulty. They couldn't keep borrowing large amounts of money to keep their businesses going, and so many of them are now facing liquidation. And the consumers in China have lost total confidence in the market because many of them paid for apartments in advance, in full. In fact, some people have mortgages on apartments that have never actually been constructed. So whereas 10 years ago, property was seen as the holy grail, everybody wanted to invest in property. Now there is a very small percentage of the Chinese population that are keen on property. Everybody else is standing back and waiting to see what happens. And what's going on in the property market still has a huge impact on what will happen in the Chinese economy. This chart shows the year-on-year movement in new build house prices in China over the last 12 months. And this metric is really important because the vast majority of the property market in China is focused on new build. The secondary market is a very small element. More than 95% of all sales are new build sales. And what we can see here is that over the last 12 months, there has only been 1 month, May 2023, when there was a positive increase in new home prices, and that increase was only 0.1%. It fell back down to 0% in June 23, and in the other 10 months of the year, house prices actually fell. And if we look at what's been happening over the last 6 months, prices came down 0.1% in October, 0.2% in November, 0.4% in December, accelerated to 0.7% in January. They fell 1.4% in February, and in March 24, new home prices fell by 2.2%, which was the fastest rate of decline seen in China since August 2015, so almost 9 years ago. And what this chart shows is that there are continuing serious problems in the property sector in China, because the developers who are actually managing to complete some properties and have something to sell are struggling to find buyers, and so they're having to keep reducing their prices to make those sales. And of course, that's again a problem because you build in a margin based on a future price. And if that future price has to come down every single month, then that's wiping out more and more profit that you'd built into your plan. And at some point, all of the profit will be wiped out. And that means that those developers that are still trading are now experiencing the same sort of pain as the developers who are already illiquid. And this is going to add even more pressure into the sector. And as we discussed, it represents 25% of GDP. So that's a big problem from China's point of view. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's going on in China right now is really interesting. And if you just looked at the headlines in mainstream media that China hit 5.3% GDP growth in the first quarter, you may be thinking, well, China is now actually doing quite well. And all those videos that I watched on Joe Blog saying that China wasn't doing very well are all a lot of rubbish. But as we've talked about today, the devil is in the detail. You need to look at what's happening with regards to the latest month and the trends. And what we've seen in today's video is that although China did hit 5.3% GDP growth, which was above the market's expectations, the reason that the economy managed to achieve that growth was that the Chinese authorities were pumping huge amounts of capital into industrial production to try to boost those figures. And that worked really well. But what we've seen is that in March, that stimulus has been entirely switched off. And we've seen a huge fall in industrial production. And it's likely that that fall will result in a fallback in GDP in the second quarter of 2024. And when you look at all of the statistics that we've been through, they tell us that there are serious problems still occurring right now, because exports were down 7.5%. And exports are the lifeblood of the Chinese economy. That's what the whole economy is based upon. China produces things, sells it to every other country in the world, and that's where it makes most of its money. So when you've got a 7.5% fall in exports compared with a target GDP growth of 5%, there is a huge gap between those two figures. And when you look at what's happening with imports, they're also down year on year by almost 2%. So that tells us that the manufacturers in China have not been gearing up for a big second quarter. In fact, it's the opposite. They're down year on year, and so it's unlikely that they're going to be able to achieve 5% growth in the second quarter. And when you look at what's happening from consumers in China, there are also very worrying trends, because retail sales have fallen in every one of the last 3 months. There is a significant downward trend. And on top of that, we're now seeing inflation evaporating, and it's likely that China could move back into a deflationary cycle. And when you look at what's happening with factory gate prices, there's a strong indication that that could happen in the second quarter of 2024. And of course, house sales are also a really important factor when you're looking at the Chinese economy, because historically it's contributed around 25% of GDP. And new home prices in March fell at their fastest rate for almost 9 years. So that tells us that the property sector is still in dire straits. It's on its knees. Developers can't find buyers. They're having to slash their prices to try to sell the homes that they have actually built. And so all of that gives us a good picture as to what's happening right now in the Chinese economy. It started the year quite well. January and February were relatively good months when you look at what happened with GDP. However, in March, we've seen a significant fall in performance. And unless the Chinese authorities do something about it to try to turn the situation around, it's likely that Q2 24 will be significantly below the 5% GDP target for the full year. And if that happens, there will then be a lot of pressure on the back end of 2024. China will need to have a miraculous second half if it's going to hit that 5% growth target. And of course, China is the second largest economy in the world. So if China is going into a period of slowdown, that unfortunately will have a knock-on impact to every other economy, because China is buying huge amounts of raw materials from lots of other countries, and it's also selling things at a low price all across the globe. So if China is contracting, then unfortunately that means that the global economy will also contract. And we've got a really interesting dynamic going on right now, because there's a lot of pressure on oil prices due to all of the political instability, particularly in the Middle East, and also what's going on with Russia and the drone attacks by Ukraine. So we've got oil prices going up, and they're sitting at around $90 per barrel, which is the highest that they've been for quite a long time. However, if China does contract and we see a slowdown in the global economy, that's likely to reduce demand for oil, and so will pull prices back down again. So we've got a really interesting tug of war right now in terms of those oil prices. We've got supply issues which are driving the price up, and we've got demand issues which potentially will be pulling the price back down. It'll be really interesting to see what does happen with both the economy and also the price of oil over the next few months. But the overall summary of today's video is that what you've seen in the mainstream media about China doing really well in Q1 is factually correct. However, when you look under the bonnet and see exactly what's going on right now, there are some very worrying signs. And unless China turns things around rapidly, it's likely that Q2 will be nowhere near as successful as Q1. And there are still major concerns as to what's happening in the Chinese economy right now. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.